REITs earned a really great return in 2012. After a really weak 2011, where do you think returns in the REIT space go this year, and what are going to be the drivers?
Well, we think REITs are valued to produce high single-digit returns. We're getting in the 3% dividend yield range, plus we have about high single-digit 10% earnings growth, and so the combination of very attractive earnings growth with some dividend yield, we think creates a high single-digit total return potential.
Can dividend growth continue even in this slow economic recovery?
Yes, we do. The companies have all recapitalized their balance sheets and they're all paying out a relatively low percentage of their cash flow. So given that and the fact that fundamentals are improving pretty meaningfully through occupancy growth and rent growth, we think the companies will continue to be able to pay out more money in the form of dividends. We're expecting about 7% dividend growth each year over the next 5 years in the US.
What sectors are you focusing on in the REIT space domestically? Is it commercial? Is it retail? Is it industrial? What's your favorite right now?
I think there's two main themes. So one theme is the consumer versus the corporate sector. So what's happened this year? The consumer has just gotten a 2% tax increase. We think that's bad for the consumer. We're underweight malls. We think retail sales will decelerate. On the flip side, corporate capex decision making has been delayed for years as people have fretted over fiscal cliff, sequestration, and we think once we get through the sequestration, corporate capex budgets will pick up, and that means companies will be making decisions again. That's good for office, that's good for industrial, that's good for several other hotels that are also tied to corporate capex decision making. On the flip side, we think government reimbursement-led tied real estate is gonna suffer. So healthcare, it's tied to reimbursements. Reimbursements are going to be cut. We think that sector will likely underperform this year.
And then globally, where do you want to be? Is it China? We're seeing a lot of growth there in real estate prices.
I do like Asia, specifically Hong Kong, though. We think Hong Kong investors is a better way to play the China recovery story. I think as China improves, demand for office space in Hong Kong will also improve. Similarly, I think Australia is a very good place. The reason for that is there's high real interest rates, meaning real estate values versus financing costs are extremely attractive. Fundamentals have bottomed, and we think there's a real shot of asset value increases in Australia today.